Club. Uh, this is S&P Finance Club monthly webinar for the month of April. It is in our culture and tradition to have this interface every month because we believe we are the forefront of fostering financial freedom in Nigeria and West Africa. And it's been a journey for us because we have been in this journey of democratizing personal finance for a very long time. And this is our way of making sure that we catch them young. Yeah. So thank you so much once again for joining us and for staying through to this moment. We are going to begin. I would like to let us know that this webinar is recorded. It's important we inform us so that we all are aware that this conversation is recorded, and hopefully we'll be able to get a clean shot that we're going to share on our YouTube channel, the S&P Finance Club YouTube channel, so that for some of us who were not able to follow through, might be able to get a glimpse of our conversation tonight. But it's also imperative that to note that this is not guaranteed. So it depends on if we're able to get a clean shot. So I'll employ us to stay through to the end because we have a whole lot to learn from this section. So tonight we have been on this topic for a while now. And it became imperative based on the questions that people have been asking on the platform. And even for someone like me, that we have this class again because it's going to help us to really understand the new tax reforms by the current administration of President Tinubu, Bola Ahmed Tinubu. We want to understand the implication on individual and businesses because some of us um, are employed and some of us have businesses and this affect us. And I don't think any of us wants to break the law. We want to be up and doing in paying our taxes. So the topic for today is Nigerians, new tax reforms, their implications for individual and businesses. Please, Jude, can you mute yourself, please? The person that will be joining us, in tackling this very important topic is a seasoned tax consultant and finance expert. Is someone that is known in the industry of tax, you know. So he's going to bring a combination of professional and even personal experience in distilling the topic to the level that we are going to understand and catch up and understand how this very important thing affects all of us as people living in the country or people from the country, you know. So it's important that we stay and follow through. Please make sure you meet yourself. So ladies and gentlemen, please a hand of applause as I welcome a seasoned tax consultant, a financial expert, a change maker, Mr. Emmanuel Anegbeh to facilitate this wonderful section for us. Please, a hand of applause. I want you guys to celebrate him in S&P Finance Club
Thank you.
culture and welcome him to this important edition of our 2026 webinar. Thank you so
Thank
much,
you. Thank
guys.
you. Thank you so much, Chizimdi. At some point, I was asking myself, am I the one being introduced, or is somebody else facilitating this? I mean, but thank you so much. As Chizimdi have said, my name is Emmanuel Anegbeh, but on this call, you can just call me Emmanuel. I'm a tax professional. And yes, I will be walking us through the next couple of minutes. We will be discussing some of the topical issues, that has come out from these tax reforms. I know for sure that even if you ask a newborn in Nigeria today, they will tell you that a lot of things have happened in the tax landscape, and a lot of people are asking questions. Some have been answered, some still require clarifications. My job today is just to walk us through together some of these changes. I prefer that we have a conversation, a dialogue, and I will just more or less be our host. And we try to answer and clarify as much questions as we can. I thank the S&P Club for giving me the opportunity to speak here, and also to appreciate my colleague, Kelechi. Kelechi has been following up on me, and it was so impossible to miss the session. Thank you so much, Kelechi. So, I mean, without much ado, we are just going to jump right in, and I will be sharing my screen. But before my screen comes up, I would just like to feel the pulse in the room and maybe take 3 comments, with respect to what our expectations are today. Just three volunteers, you just maybe raise up your hand, tell us your name, and you just tell us what you expect to take out um, from today's session. So that gives us a feel at the end of the day as to whether we've been able to, hit our targets or not. So we'll just take 3 comments from the room. Anybody? Please go on. Just unmute and speak.
Okay, good evening. My name is Adejoke. So my expectation from this session is to have an insight of how the Nigerian tax law affects companies in the oil and gas industry. Thank you.
Thank you. Thank you so much, Joker. And yes, I mean there have been a lot of changes there, and I'm sure we are gonna get to that as well. Yeah. Any other comments? Any other expectations before we jump right in?
Okay, good evening, everyone. My name is Emmanuel, and my expectation is to have a better insight of the whole taxation issue, especially the new one that will start on 1st July, vehicle taxation. What is the cost? What will be the amount? What will it cost the average Nigerian who have a big vehicle or four vehicles? What are the effects? How are you going to affect us? Do something that will drain us more. Things we already been drained with the fuel increase, the fuel price issues and all that. Thank you very much for that.
Thank you. Thank you so much. And one final comment, the third comment.
Good evening, ladies and gentlemen. My name is Chisimbioko. I just want to know how this new tax reform affects me as an individual living outside the country. Thank you so much.
Great. Great. All right. I mean, I am quite confident that by the end of this session, we would realize some of our questions would have one way or the other been attended to, you know. So we're just gonna start. And because I am presenting my screen, I won't be able to see any raised hands. So I'm just gonna ask Kelechi and Chivimdu. Please, if there's any indications, you can just feel free to draw my attention to it so we can take questions or contributions as they come. Like, okay. So the first question we need to ask ourselves is, why this new tax reforms? Why did we suddenly wake up in Nigeria and decide, you know what, we are going to have to overhaul our tax system? Because that is what has happened here, really. We have completely overhauled it in such a way that if you were to go back in time, 2024, and come back in 2025, you actually would not recognize the Nigerian tax laws anymore. What we have done here is to completely change the landscape. The big question becomes, why did we have to do this? Why did we have to do this? Um, Before I go into the why, I'm going to tell you that for every time you hear the tax reforms and every time you hear the tax laws, please always note that there were in fact 4 acts that were signed into law. A lot of the time, people think it's just one. In fact, there were 4 different acts that was introduced. What you find is because one of them is directly responsible for our daily lives, that one became very popular, the Nigerian Tax Act. And you hear a lot of people seem to know a lot about the Nigerian Tax Act and almost neglecting the other 3, which we are going to quickly run ourselves through on this call. So yeah, 4 acts were introduced, and one is the popular one, the Nigerian Tax Act. You know, this one talks about the taxes that Nigeria should collect as a country. What taxes should we collect as a country? And that is what the Nigerian Tax Act codified. Now, what this act did is, before now in Nigeria, you will find that all the different laws were codified in different books. Let me use that word, books, so that we can relate with it. So the laws that dealt with how companies should be taxed was written down in a separate book and called the Companies Income Tax. The Companies Income Tax Act. The laws that guided how individuals will be taxed was then written in another book called the Personal Income Tax Act. And then if you wanted to check the laws that governed things like capital gains and chargeable assets, you needed to go to another book called the Capital Gains Tax Act. And then if you wanted to check about value-added tax, again, you needed to go to another book we have called the Value-Added Tax Act, and so on and so forth. Even stamp duty had a different book. So you can imagine having to go through different types of books and different types of laws. And then you have your library so big with 20 different laws that you have to read as a Nigerian. You know. But what the Nigerian Tax Act did was to then bring all these books together into a single document that it has called the Nigerian Tax Act. The Nigeria Tax Act, which means all the laws that govern the taxes that should be paid, you find it in a single document. Again, we go to the remaining 3 books, the remaining 3 acts that were signed. The second one, and in my opinion, the second most popular one, is the Nigerian Tax Administration Act. You know, the first one talks about the taxes that we should collect. The second one, which is the Nigerian Tax Administration Act, talks about how we should coordinate these taxes. How should these taxes be governed? And then, of course, there is the third one that, in fact, established the Nigerian Revenue Service. I am sure a lot of us have seen the logo of Federal Inland Revenue changed to Nigerian Revenue Service. There was a new act that established the Nigerian Revenue Service, and that one is called the Nigeria Revenue Service Establishment Act. That act indicates who should collect these taxes, and therefore it established the NRS, the Nigerian Revenue Service. Then, of course, we have the final one, which talks about oversight and taxpayers' rights and protection. This is where you run to sometimes when you begin to have issues and misunderstanding with the tax authorities, which sometimes are inevitable anyway. The Joint Revenue Board Establishment Act. So I just want us to know on this call that 4 acts were in fact introduced, not just the Nigerian Tax Act, there were 4. And the 4 are the ones I have taken my time to break into these 4 rectangles that we can see here. All right. Now, why did we decide as a country to introduce new laws? Was it because we didn't like the old ones? Why? Why? The first reason why we tried to do this was to try as much as possible to simplify these laws. That was the first reason. We tried to make it even simpler. I'm sure as we go on, a lot of us will have 1 or 2 issues, and we might feel have these laws even come to make it more complex because there are certain issues that everybody is trying to navigate at this point. But one of the first policy objectives was to actually try and make it simple. The second one was to harmonize, which I have touched on earlier. So we decided that instead of having our laws scattered all over the place in different books, let us have them codified in a single document. And as you can imagine, that would be easier to reference than having to start picking up different documents for different taxes. Alignment with economic objectives. You know, when you have a new administration like this, they will come with their own objectives. And one of those objectives you find would be revenue generation, right? And so there will always be the need to try and, unbundle a lot of things in such a way that if you have your various revenue targets, then you want to make sure that the NRS, for instance, is well positioned to achieve this objective that you have set out for yourself. Competitiveness, and this one is very important. It was important as a nation that we remain competitive. And I'll give us an example. The tax landscape continues to evolve. Nigeria does not operate as a nation in isolation. We are a member of the larger globe. And what that means is you have to deal with taxes across international borders. And when you have international organizations introducing new laws, new taxes, you find that you can't just fold your hands as a nation and sit down and not respond to some of these changes that are being introduced globally. You need to make sure that whatever is going on globally, you fit into those narratives in such a way that as a nation, you are not left behind. Also, because we wanted more certainty, we decided to overhaul these tax laws. I'm going to give you an instance, and I'm not to get too technical, but if you look at our old Stamp Duties Act, for instance, it had a lot of issues. People not knowing who was responsible for stamping, people not knowing what rates should be stamped, and all those kind of confusion, right? And so the new law decided to come and try to make a lot of things even more certain so that people are clear when it comes to their obligations with respect to taxes. Of course, one of the objectives was to try and modernize our tax laws. I mean, if you keep the old, let me say, capital gains tax, for instance, or let me come back to stamp duty. If you take the old Stamp Duties Act, you find penalties in there saying, oh, if you do not do this, if you do not do that, you will pay a penalty of, you can even see as low of 50 kobo. In fact, the old Stamp Duties Act had stamping rates of 50 kobo, 25 kobo. I mean, I can't remember the last time any of us on this call, yes, or 50 cover, you know. And what then happened was people started stamping at 500 naira, 1,000 naira, just because they needed to stamp. But the law actually said 50 kobo. But 50 kobo has, I mean, it's been saved down, but we still had it in the law, you know. So we clearly needed to modernize and bring our laws up to speed. Efficiency of compliance and administration. Of course, this is where the NRS comes in. You know, a single regulatory body that would be responsible for collecting these taxes in order to avoid unnecessary duplication of responsibilities here and there. We had situations where other government parastatals began to transform themselves into revenue collection agencies. That was not necessary, you know, and some of them started even giving themselves revenue targets, leaving their core objectives behind. But what has happened now is the NRS has come to harmonize this responsibility into one body, the NRS. So what will then happen is it gives the other government parastatals like customs and the likes an opportunity to in fact focus on their core mandates and not really bother themselves with revenue generation, as that in itself was not why they were established. And of course, the last one, evidence and data driven. You know, so these are the core reasons why the reforms came. And I am sure once we understand these reasons, we will begin to see beyond the noise that perhaps these reforms were really important. Okay, let us now go into the meat of the conversation and start discussing the changes that these laws have come to introduce. The first change on my slide here is who a Nigerian company is. And why does this matter? The way you define a company will determine how and what income will be taxed. Under the old law, the definition of a Nigerian company was very simple. Once the company is incorporated in Nigeria, it is defined as a Nigerian company. Very, very simple and straightforward. But then, me and you will then realize that in modern times, I can be in Nigeria here. I don't even have to be in Nigeria, you know, to carry on my operations in Nigeria. What that then means was that definition became archaic. It became old school. We needed to then revisit that definition of a Nigerian company. Like I said, initially, the definition of a Nigerian company just bordered solely on incorporation, right? But now, we have introduced more layers to it. And introducing more layers to it is not because the government is trying to be desperate. No, it's just because it's important that we respond to modern times. Back in the days, in the good old days, you had to actually be physically in a place to run a company. But today, I can be in Japan and be running a company in Nigeria. In fact, I don't even know where Chizimdu is right now. Maybe he's in China, coordinating this call in Nigeria. Nobody knows. I don't even know where Kelechi is. Perhaps he could be in Canada, coordinating these calls in Nigeria. That is what modernization has brought. It then meant that the laws needed to respond and expand the definition of a Nigerian company. And then we decided to say, it is not just enough for you to be incorporated in Nigeria. If we find out that the central place of management or control can be pinned down anywhere in the world, once we discover that your central place of management or control can be pinned down, it also becomes a parameter for us to define you as a Nigerian company. There's also what we call the effective place of management or control. Now, very quickly, I'll try to differentiate these two. Now, as we know, a lot of companies usually hold AGMs, annual general meetings, and all that. And as we also know, it is also possible for me to be the key decision-making person in a company, and I'm residing in Japan. So what we do here is we can check where you usually hold things like your board meetings, your AGMs, right? And decide that, look, if these things are held in Nigeria, then we can tell you, even if you are not incorporated in Nigeria, that your central place of management or control has brought you into the tax list. Also, effective place of management or control. We discovered that your key operational activities are affecting businesses in Nigeria here, are affecting your operations in Nigeria here. Then we can, on that ground, classify you as a Nigerian company. We disregard whether you were incorporated in Nigeria or not. Again, the idea of small companies and small businesses have slightly changed as well. Because, you know, if you pay attention to the economy, you discover that a lot of rebasing are taking place. You know, even the naira to the dollar that used to be 185 to $185 to 185 naira to $1 some maybe 7-10 years ago. You and I know that we will have to cough out thousands now before we get a dollar. Clearly, we needed to revisit the definition of a small company for the purpose of tax. And what have we said here? We have said small companies are companies with a gross turnover of 100 million or less, and total fixed assets not more than 250 million. Please let's pay attention to the two clauses. They have to go together. 100 million or less in gross turnover and 250 million in fixed assets. Now, why is this definition important? It is important because the law has now come to actually exempt them from company income tax. Now, what does this mean for me and you? It means that technically, it is in fact better for you to formalize as a small business owner, because 100 million and below in outside turnover is actually exempted from company income taxes, which means you would not really need to bother yourself as a small business owner with payment of a lot of taxes here and there. The law has come to give you some comfort. Now, what are the benefits? Of course, I have mentioned the first benefit is to file a statement of account attested by the taxpayer. Now, what this means is, unlike the larger companies who would need to always prepare audited financial statements, for small companies with turnover of less than 100 million, all they will just need to do is prepare their management account and get a member of management to attest to it. That's all. You don't need to engage one big auditor here and there, and they start incurring extra audit fees, and then one tax authorities chasing you all over the place for what you have packed. This time around, for small companies, just prepare what we call a statement of account. And the member of top management will just stamp it and say, yeah, this is our record. You file it and you are good to go. Also, a small company is not required to pay VAT. And this is actually huge, you know. This is huge for small companies because it will significantly drive down, you know, your cost of compliance and even your cost of doing businesses. Again, there's what we call the development levy. I'm just going to skip this because for development levy, it's usually paid at 4% for those of us who are familiar with it, you know, but for small companies are exempted from that. One of the major ones is what I have mentioned earlier, no CIT payable because you are actually exempted from companies' income tax. So CIT simply means company income tax. Now, losses can be carried forward, after allowances can be carried forward, which means when, you know, because you are not paying CIT, whatever tax losses you have and after allowances you have, you can then move them forward when you become a big business. Also, one of the areas that a lot of companies usually fall short is when it comes to VAT compliance. I'm sure a lot of business owners do not even know that VAT file VAT filing should be done every month. Every month. And what you find is suddenly the regulator will wake up and write a business and say it's not been filing your VAT for the past 5 years of doing business. The business owner is not even aware, and then it becomes a significant issue. But the law has come to actually exempt small companies, you know, from all this rigor of having to comply with taxes. It exempts them from filing VAT returns as it were. So you can see very clearly that in the midst of the confusion, in the midst of the noise we've been hearing about this tax reform, if you really sit down and from a small company perspective, you will see these new laws have actually come to make life a little easier for the small business owner in Nigeria. Good. Our corporate tax rates have not changed. It has always been 30%. This new law also maintains it at 30%. It didn't change it at all. But you should know, of course, that any company that is not small is required to pay, which means small companies, like we said before, are not captured, are not captured here. Okay, now for those of us on the call who are a little familiar with the old law, what you find is in the old law, even when you compute your company's income tax and you say, government, I made a loss, you know, ideally it is your profit that will be taxed. Now, if you compute your company income tax under the old law and you made a loss, government will say, okay, set your loss aside because we don't want to go empty-handed. You must pay what we call minimum tax. And that minimum tax is then taken as a percentage of your revenue. And government will say, go and pay it because we don't want to go empty-handed. We must collect something from you. And a lot of companies, even though they were making losses, were still having to pay taxes to the government. But what this new law has done is to abolish that practice. It just totally abolished that practice. Under this new law, it is in fact possible for me to arrive at a taxable loss and not pay taxes because I made a loss. And that's it. There is no longer any such thing as a percentage of your revenue must be paid. No, it has abolished that practice. But It then introduced what we call a 15% minimum effective tax for very large companies. And I'm going to give us very quickly the history of this 15%. Recall that earlier we have talked about introducing reforms because we needed to, one, modernize our laws, and two, stay competitive. So let me give us a quick history. There is an international body that we call the OECD. OECD. This international body regulates things like taxes at the global level. Now, I am going to try to be as basic as possible so that we can follow. Now, this body at the global level introduced a law telling big global companies that, look, we don't care how many branches you have in various countries, because we have realized that a lot of you are trying to take advantage of tax loopholes here and there. You are beginning to pay too low taxes in some jurisdictions. That means there are some jurisdictions where we have discovered that your tax that you have paid there is not quite significant. We don't want you to keep escaping from tax. So what have we decided to do? We have decided that all those your locations, by the time we check, if their taxes that they pay there is lower than 15% in a way that we will compute it, then the head office of that company, wherever it is, will have to pay up that difference. Let me give out an example. If I am a company in Spain and I have a branch in Nigeria or a subsidiary in Nigeria or whatever, and that subsidiary in Nigeria pays tax, and they calculate the effective tax rate of that tax, and they get 7% in Nigeria, no problem. What will then happen is the exporters in Spain will have to pay 8% top up in Spain. Now, what that means technically is the country where that 7% was paid has lost 8% to another country. That was why Nigeria also needed to respond to make sure that we are not losing taxes to anybody. Which means in Nigeria now, if your company is a member of a multinational group, that company in Nigeria cannot pay taxes less than 15% effective tax rate. The reason is simple. We do not want to lose any tax to any other person. Simple. Which means if you compute your taxes and you discover that the tax you have paid by the time you do the ECR is less than 15%, let's say you got 10%, the new law says because you are a member of a multinational group, you must top it all by another 5% and pay us, so that your head office, wherever it is, will not go and be paying that top-up tax to another person. And that was why this minimum ECR was introduced. But it is not applicable to all the companies in Nigeria. It is only applicable to one, companies with aggregate revenue of 50 billion and above. And also companies who are a member of a multinational group, and that multinational group together has a revenue of 750 million pounds combined. Once you fall into any of these two categories, then this effective minimum tax becomes applicable to you. If you do not fall into any of these categories, then you don't need to bother yourself with this 15% minimum ETR. Very, very interesting. All right. Um, so last slide there just talked about how the ETR is calculated. I really don't want to bore us with it. I just wanted us to understand the concept and the reasoning behind the minimum ETR. Good. I mean, on this call as well, I do not want to bore us with the computation um, of company income tax. I really don't want to bore us with the granular computations of it, right? So I'm just going to skip this so that we move to the changes that have been introduced. Please, if there's any hands up or anybody wants to make a comment, please just prompt me so that we can take the comments. Okay, so let's talk about the other changes that was introduced into the company's income tax. All right, we talk about salaries and wages. We say no restriction to deduction of benefit or allowance paid to senior staff and executives. Under the old law, we used to have some form of restrictions, with companies having to get approvals for some of the allowances that they pay to their senior member of staff. But if you go to section 20 of this NCA, we no longer have those unnecessary restrictions, really. Again, we talk about donation. Just because we know that companies are typically not set up just to be donating all over the place, right? But we also know that sometimes these donations are inevitable. This new law is saying, yes, of course you can donate, but when you have your donation, then you must always check and make sure it is not greater than 10% of your profit before tax. This means when I calculate my profit before tax and I have donations in my books, I must do that check to make sure that my donations is not higher than 10% of my profit before tax. Right? Disability-related product expense incurred by a person on assistive devices and disability-related products are allowed now. Pre-commencement expenses, now this one is just clear. This law just came to clarify the treatment of pre-operational expense. Because before now, some people will say, capitalize it. Some will say, expensive. Some will say, oh, amortize it. Everybody with different school of thoughts. The law is clear now. It brought certainty to it. Earlier, we talked about certainty. What the law has done now is to bring certainty to the treatment of pre-operational expenses. And section 20, subsection 1, just says that trade or business expense incurred by a person 6 years prior to commencement, to just be expense. So these expenses are deductible where they are wholly and exclusively incurred. I'm going to take a moment and explain wholly and exclusively. Under the old law, there were 4 conditions for which you will be allowed to take a deduction. 1, it had to be wholly incurred. 2, it had to be reasonably incurred. And 3, it had to be exclusively incurred. And 4, it had to be necessarily incurred. We call it WREN, WREN. Now, this created a lot of chaos, actually, because you now find yourself as a taxpayer having to defend expenses under these 4 subcategories. Somebody will say it passed the reasonability test, but it does not pass the wholly test. It does not pass the necessarily test. So we are going to disallow it. So we used to have a lot of back and forth. But what this new law has come to do is to reduce those 4 conditions to just 2. To say, as long as the expense is wholly incurred and exclusively incurred for the purpose of your business, then you are allowed to take full deductions, subject, of course, to all these restrictions introduced in each of these sessions. All right. Um, but and that will get some related parties. I'm sure a lot of us are familiar with related parties, right? This new law has now found significantly at you having bad and doubtful debt from your related parties. It disallows it outrightly. It disallows it outrightly. And you can see the logic in it actually. If I have related parties, of course, there's a chance that the debt between my related parties might never be paid, right? There's a chance it might never be paid, not because business is bad, but just because we are related. And then you see related companies carrying bad debts in their books. This new law disallows it outrightly. Now, this one is actually very huge and very significant. Before this new law, the only condition, like I mentioned earlier, was to prove that the expense passed the rent test. This new law has now introduced a different layer to say that for any expense that is vatable, then you must demonstrate that the VAT on that expense have been properly accounted for, have been properly charged. Where you cannot demonstrate that VAT is due and VAT was charged, this new law will not allow you to take that deduction as an expense in your books. So what it is trying to drive is it's trying to drive VAT compliance to make sure that you actually properly account for the VAT on your business expenses. All right. So the ones to my left are deductible and the ones to my right are non-deductible. I'm going to pause here and maybe take one or two comments before we go ahead. One or two comments, one or two questions. Sorry, can we hear me?
Yes, we can hear you.
Good. I was saying that I was going to pause and take maybe one or two comments just to make sure that the house is following.
Yeah. Um,
Or one or two questions or contributions.
I think it may be better we flow, then at the end of the class we can now entertain questions so that we will not
Oh,
be interrupting you.
that works. That works. Fantastic.
Mm,
So
yeah.
I'm just gonna push ahead. Okay. Again, we are talking about changes introduced by this new law. And here we have three classifications for assets, asset claim for capital allowances. The first class is at 10%. We have there those lists there: building expenditure, agriculture, health. Now, I'm not going to read through the lines. I'm just going to tell us where capital allowance comes in. Now, as accountant or as finance professionals, we know that when we are preparing our books, right, there's what we call depreciation. For every asset we buy that is used for business, the law allows us to depreciate it in the books. That means if I buy an asset for 100 naira, I'm allowed to hold it in my fixed asset and decide the number of years that I want to use that asset for. If I decide to use it for 5 years, the law allows me to then be depreciating 20 naira every year until the 5th year. Now that's depreciation. But you will discover that for depreciation, companies can have different depreciation rates. And if we have different depreciation rates, it means that even if we make the same profit, because we have used different depreciation rates, our profit before tax will be different. It means with my depreciation, I can determine my profit before tax. I can make it higher or I can make it lower. The taxman does not like that uncertainty. He doesn't like it at all. He prefers to be very certain. So what did he decide to do? He decided that instead of giving you depreciation, it's going to give you capital allowance. Capital allowance is the same for all companies, regardless of what industry you operate in. The capital allowance provisions are clear in the rule. That means you can't wake up and decide by yourself to use any other rate. No, you must use the rate as spelled out in the law. So the taxman will take your depreciation that you have enjoyed the deduction for, he will add it back. And once he adds it back and subjects it to tax, it will then give you a different type of relief that is called capital allowance. It prefers capital allowance because capital allowance is more structured, more certain, more regulated. So for each of the classes of assets, you have the rates here for building 10%, agricultural, that 10%, heavy transport, intangible assets. 20% you have for plant expenditure, mining, agricultural equipment, and then of course 25% for your motor vehicles, software expenditure, and other capital expenditures. Which means if I have a motor vehicle as a business, even if I say this my motor vehicle, I want to use it for 10 years, and I am now depreciating it in my books at 10%, the taxman will disregard my 10%, and the taxman will apply 25%. All right. Now, let me take a moment and go back to capital allowance. There's something significant there that is not on my slide. Under the old law, capital allowance were majorly could be initial allowance and annual allowance, right? I'm not going to go into the details of how it's computed, but I just want us to know that the new law has done away with the initial allowance. So now you just have your annual allowance. Now for withholding tax, a lot of us will not be very happy with some of the changes introduced from the withholding tax perspective, especially for number 2, because before now, there was a regulation or a circular, if I can call it that, actually putting a pause on withholding tax on short-term investments, right, by individuals. But now, this new law has come to say withholding tax on interest earned by individuals on short-term securities and corporate bonds earned by individuals will now be the final tax. So yes, all our short-term investments here and there, money point, no, is it money point? Our mutual fund, interest we get basically, I'm sure if some of us begin to see the let's say payments instructions now, you will actually see withholding tax being deducted. But this time around, as final tax. Final tax simply means no further tax will be suffered on that interest. The first one there says withholding tax on dividend, interest, rent, royalty, director's fee, entertainment, sports fee paid to non-resident person is final tax. I know someone had mentioned earlier when we were talking about our expectations, that he wanted to understand how taxes will be applicable to him as a non-resident, you know. But when you are classified as a non-resident, we look at 2 key things. One, are you a non-resident for the purpose of just source income alone? That means I am living in China and I have investments in Nigeria, just investment, passive investment, right? Those passive investments will be subjected to withholding tax, and that will be the final tax. It means I do not need to file, I don't have any obligation to file taxes in Nigeria. Just take your 10% or your 5% on this my passive income, and good night. I don't care what else you do, right? But if you are a non-resident and you have significant presence in Nigeria, like a permanent establishment, a P, it then changes the game a little bit. It changes the game a little bit. It then means that that income might no longer be the final tax, apart from dividend, of course. But the income might no longer be the final tax. It means you might then have some filing obligations, for which you need to then declare that you made this income, take the taxes, but then bring the credit note, that you have suffered already, and then knock it off back. The difference is just that for passive income, you do not have filing obligations, but where you have significant presence, um, um, a permanent establishment, then you might discover that you then have filing obligations in Nigeria. That's one of the key differences between those two things. Of course, withholding tax on technical consultancy, professional management services is now at 5%. More importantly, there's actually a withholding tax regulation, right, that regulates this space for withholding tax. So I would actually employ us to grab the hold of that withholding tax regulations, and we will get more details with respect to the specific withholding taxes that are applicable for each transaction, depending on whether you are an individual, whether you are a company, whether you are a resident company or a non-resident company, and depending on the nature of the transaction, the rates vary between 5%, 10%, 2%, and the likes. Okay, now let's quickly run through the changes introduced with respect to VAT. The first one here is impute VAT deduction. Now, again, I will try not to be too technical, right? For every company, when you sell, you must charge VAT. Okay, no, let me not start from there. Let me start from here. For every company, you need to first of all decide whether what you produce or the service you render is, one, VATable, or two, VAT exempt, or three, what we call zero rated, right? Now, if your service is VATable, it means that for every time you raise your invoice, you must put VAT on it. And the person you are rendering that service to must pay you and also pay you that VAT. Of course, there are some companies that the law has positioned as agents for collection of VAT, which means those who pay you the VAT, like oil and gas companies and banks. If you deal with those ones, they will pay you your money, but they won't pay you the VAT, right? But generally, other companies, if your service is VATable, you will VAT it. Assuming you are a big company, you will VAT your invoice, they will pay you plus the VAT. Then you are supposed to take the VAT by yourself and then go and remit it to the NRS, right? Now, that is on your sales. Now, the same thing happens for your purchases. If you go and enjoy services, which means if you go and buy maybe products or whatever that you need in the place of trying to render that your service, you discover that other people would have charged you VAT as well. And you would have paid them the VAT. That VAT that you would have paid them, we call it impute VAT. So the one that you charge on your sales that people pay you is called output VAT, while the one you pay on your purchases or your cost of sales is called input VAT. Now, under the old law, this input VAT was usually expensed depending 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 on how your VAT mechanism works. Right? So under the old law, once I render a service, once I render a service, the input VAT will just be expensed because claiming of input VAT was restricted to only those who literally deal in, say, manufacturing of goods and services. I mean, manufacturing of goods. So if I was into rendering of services, I could not claim input VAT. I could only just expense it. But this new law has come to change that, to say that whether you are rendering service or you are manufacturing goods, we don't care anymore. Any input VAT that you suffer, you can now claim it against your output VAT. That means if I charge VAT of 100 naira and the person pays me, before I give government the 100 naira, I must first of all check whether at the point when I was purchasing, whether I paid any VAT. And if the answer is yes, it means that I will take that VAT I paid, subtract it from the 100 naira, and pay government the balance. So this new law actually expanded the scope of claim for input VAT. But of course, the government does not want you to just continue holding all this forever. So there's a 5-year limitation. So if after 5 years you gather input VAT, and after 5 years you couldn't claim them all, then of course it will be deemed lost. It will be deemed lost. Now, again, we talk about fiscalization and e-invoicing. A lot of us must have heard of this e-invoicing, right? Some African countries have already implemented this. The likes of Kenya, for instance, have implemented e-invoicing. And we are trying to model ours as well into something similar as what the Kenyans have done. What is going on here is the government is just has decided that, look, we want to see your activities in real time. We don't want to sit down and wait until the end of the year before we then come for audit. And then we then say, Idindu Limited, bring all your invoices out. Then you will start gathering them. Then we say, Kelechi International PLC, bring all your invoices out. Then you start gathering them in the audit. You see everybody gathering paper and documents all over the place. No, the government have decided that, look, we don't just want to wait for you anymore. We want to be seeing all your invoices real time. So that when we are coming for all this, for instance, we are coming to you fully armed. We already know your transactions. We know what your revenue should look like. You cannot come and tell us otherwise. You know? So it just creates that bit of more visibility. But for now, I mean, there was a recent circular introducing timelines for when companies are expected to implement this e-invoicing. I think that for now, companies with turnover of 5 billion and above are absolutely, I mean, they have already started implementing this, right? In such a way that you will have to integrate your system such that when you read your invoice, it transmits automatically to the NRF and they can see real time. You know, the challenge with this is if you don't comply, right, then, I mean, it becomes very difficult for you to enjoy some claims and some relief if your invoice is not fiscalized. A fiscalized invoice is one that has gone through the e-invoicing system. So that's just the surface, I mean, level discussion on invoicing. There's a whole lot to discuss there. But I mean, that will probably be a conversation for another time. Now we talk about the zero rated goods. Very quickly, I'm going to differentiate between when a good is zero rated for VAT and when it is VAT exempt. When a good is zero rated, it simply means that that particular goods or service is VATable, but at 0%. That is what we call zero rated goods or service. This goods or service is VATable, but at what? At 0%. But when we say a good or service is exempt, it means that it is outside the scope of VAT. It is not VATable at all. Now, there's a technical difference between the two. The technical difference is that when a good is zero rated, it means it is VATable at 0%. What that means is any impute VAT that you have paid can be reclaimed from government. Any impute VAT that you have claimed can be reclaimed from government, which means even though you don't have output VAT because it is at 0%, but if you have suffered VAT on your sales or your purchases, you can gather it and go and seek a refund from government. That is the beauty for zero rated goods. But for VAT exempt, once your goods or service is VAT exempt, then you don't have scope to claim any impute VAT. Any impute VAT you suffer, you can only expense it. That's the technical difference between when a good is exempt and when it is zero rated. I am sure that with this alone, a lot of us will prefer that our services are zero rated, so that the impute VAT we suffer in terms of trying to render that service can be claimable. Which is why the government then decided to move some goods away from VAT exempt and put them under the zero rated bracket, so that people who suffer impute VAT can gather them and seek a refund for them. So government tried to move out basic food items that were previously exempt. It moved it into zero rated. Medical products moved it into zero rated. Educational materials moved it into zero rated. It's just to make it, to even increase the release that this zero rated items will enjoy. Okay. Of course, I don't want to go into the update to the VAT sharing formula. We know how, in fact, if this tax reform was going to fail from the beginning, it was majorly down to this sharing formula because there was a lot of discontent, I think, with the sharing formula. But of course, the new reforms also moved things around a little bit, such that now federal government gets 10%, states get 55%, and of course, local government 35%. Then, of course, you see that the further allocated among states as follows: 50% equally, 20%. So I mean, we can just read this up. Right? We can just read that up. This is a more government issue, but they have they actually hold significance for us, really, as citizens. Well, let's pack that up for now. We've talked about VAT expenses for which VAT was not accounted for. We talked about that being disallowed. Then we also talked about impute VAT credit and refund. Of course, impute VAT that exceeds output VAT, we have said can be carried forward as a credit to be used in subsequent months. And you can request for it. But of course, we have mentioned earlier that you then need to always do that check because we cannot carry them forward for more than 5 years. All right. Earlier on, I talked about stamp duties. And I had mentioned how the old Stamp Duties Act was a little bit outdated, and now it was not clear with respect to some things. But this NTA, this Nigerian Tax Act, has actually come to provide some bit of clarifications, right? Now, the NTA is clear as to who is responsible for stamping. Before, during audits, you see the FRS will come to company A and say, where is the stamp on this instrument? Company A will say, I don't know what you are talking about. I am not responsible for stamping. The law is not clear. FRS will go to company B. Where is the stamp? Company B will say, I don't know what you are talking about. I am not responsible for stamping. The law is not clear. Or you see two companies going into an agreement. Company A will say, stamp it. Company B will say, I'm not starting you to stamp it, because stamping is always like an extra cost, especially when you are stamping on the value of the asset. You know, stamp is usually of two types, either flat rate or ad valorem, right? So it can become significant because sometimes when the base is high, then the stamp can become very significant, right? But the old law was not very clear as to who was responsible for stamping. So what you saw was the person who felt that they were going to suffer if that deal failed. The person who felt they were going to be at a loss position were the ones who were ultimately going to stamp. Because you know that in the court of law, if you fail to stamp, then there's a risk that it might not be tenable as an evidence, except, of course, if the case is a criminal case, right? But if it's just a normal case, you fail to stamp the document, the courts might not accept it as evidence. So the person who felt that if this deal failed, I'm going to suffer, I will put my hand on my head and start rolling on the floor and weeping, that person was seen as the responsible person who should stamp, you know. But this new law has come to take away that uncertainty. And specifically, it has then listed those who are responsible for stamping, depending on the nature of the instrument. It says transferee, payee, borrower, beneficiary of the service. These are the people who are responsible for stamping. And of course, it then provides a uniform 30-day deadline for all documents, distributable documents executed in Nigeria to be stamped. Now, this is important, right? The last one there, exemption of lease agreements less than 10 million, right? Is exempted from stamp duty. I'm sure a lot of Nigerians will fall under this category, you know, where your lease agreement falls below 10 million naira, then you really do not need to bother yourself with, with, with stamp. Okay. Of course, these are the penalties and interest for various infractions as far as taxes is concerned now. So you don't want to find yourself in this category, actually. You know, failure to register for taxes. 50,000 for the first month and 25,000 for every month that this failure continues. You might think is it not 50,000? I will pay it. But just imagine that you have done business for 5 years and somebody suddenly writes you and says, we discover you have been doing business and you have failed to register this your business properly for the purpose of tax. And they suddenly need to calculate the penalties and the interest from 5 years ago. Applying this rule, then you will understand that it is in fact not a small amount of money. But by the time they pay 25,000 naira for every subsequent month that the failure continues for 5 years, then you know you are talking about millions in, in, in liabilities. Also, failure to file returns, you have the penalties there, where you fail to file your returns before deadline. 100,000 for the first month and 50,000 for every month that the failure continues. So, for instance, companies with year end of December will typically need to have filed their taxes before June of the next year. Where you fail to file before June of the next year, by July, it is an automatic 100,000 naira. And therefore, every month that you fail to file it, you then discover that you're already topping it up with extra 50,000 naira free money to the government. What you then see here is that the cost of non-compliance is beginning to um, become more expensive than the actual cost of compliance itself. We have other penalties there. Um, Failure to keep proper account. If you are an individual, 10,000. If you are a company, 50,000 naira for that's for small businesses anyway. Which means we come to you for audit, we can't see any record, nothing to show. You told the whole paper, whatever it is you have done. I mean, there are penalties for that as well. For VAT claim, of course, the penalty for that is you will pay the VAT plus 100% penalty, and then of course interest at the ruling monetary policy rate. Failure to grant access to tax authority. You know, today I was still having a conversation, and someone said, look, when they come, I will not show them anything. They are not the ones, the road is not good. Nobody is providing electricity. Why are they disturbing me? There is actually a fine for failure to grant the regulation, I mean, the tax authority access to, to technology that you have deployed, for instance, and that one is huge. 1 million in the first month that they came to ask you, and 10,000 naira for every month that failure continues. This one is important because of the VAT fiscalization policy, the e-invoicing policy that was actually introduced. Good. We are beginning to come into the personal income tax space. And now, the new law now has expanded the scope for taxing a resident. We have said residents now will be taxed on their worldwide income. Will be taxed on their worldwide income, which means even if I'm a Nigerian, you know, resident in Nigeria and doing some kind of business in the US, Canada, wherever, I am actually supposed to declare all those incomes alongside my Nigerian income and do my filings accordingly, you know. And there are ways to determine whether this your income as an individual will be subjected to tax in Nigeria. One of them, of course, is whether you are domiciled in Nigeria. That one is the obvious one. But even if you are not domiciled in Nigeria, but you have a permanent place you use in Nigeria for your domestic use, we will drag you into our Nigerian tax net. Now, even if you are not domiciled in Nigeria, but you have immediate family ties, your wife, your children, they live in Nigeria, those are your immediate family ties. Please, you are a resident of Nigeria for the purpose of tax, and your worldwide income will be subjected to tax. Even if you say, I do not fall under any of this category, we will check the 183 days rule and try to see if you have resided in Nigeria for at least 183 days within a 12-month period. We then define you as a resident and tax you on your worldwide income. Now, of course, there is a place for some kind of relief where Nigeria has some form of double tax arrangement with those countries, right? It then means that whatever taxes you have suffered in those countries can be used to reduce the taxes that you are supposed to have to pay in Nigeria. But that would then be if Nigeria has what we call double tax arrangements with those other countries where you perhaps reside. Okay? Yeah, and I just talked about this. relief from double tax, because now we are saying that you will be taxed on your worldwide income, but we are also careful because Nigeria has some tax agreements with other countries to try and avoid double taxation. Because I'm sure a lot of us on this call would have been thinking, is this not double taxation? Is this not greediness? Why do you want to subject an income that has been subjected to tax in the other country? You want to subject it to tax again in Nigeria? Yeah, the law got you. And it has said here that when Nigeria has a double tax treaty arrangement with that other country where you reside, then of course, that foreign tax you have paid can actually be utilized as a credit when filing and paying your taxes here in Nigeria. All right. What I just want to draw our attention to with respect to chargeable income is that the law has actually expanded this. So, I mean, chargeable gains, once you dispose of an asset, right, the gains you make is actually supposed to be subjected to tax, right? But what this new law have just done is to expand that scope to now include things like your virtual assets. And the one I found funny or interesting really was on Arabia. So I told myself, a lot of these speakers, pastors, now need to be careful now because honorarium now is, I mean, it's gonna be part of your chargeable income. If you have edging instruments, those edging instruments where this one is common in the financial sector space, where you pin down the value of an instrument, and you say to the bank, I don't care what the value of this instrument is in 6 months' time, but I am going to buy it from you at 500 naira, and it's edged in that manner. And by the time you come back to maybe sell it off, it's possible that the price has moved to 5,200, or it's possible that the price has fallen to 480 naira, right? Depending on the movement, the price has been edged as 500. So you can either make a gain, you can make a loss. But once you find yourself in that kind of space, that gain you make from those edging instruments is now brought into the band of chargeable income. Awards, prizes, basically whatever comes to you as an income is there's a chance that it's going to be chargeable to tax. Employment income is taxable in Nigeria, where, of course, we talked about the individual being resident in Nigeria, or B, the duties of the employment are wholly or partly performed in Nigeria. And the remuneration while in Nigeria is not duly liable to tax in the employee's country of tax resident. So you are chargeable to tax basically where you are deemed a resident. And if we go back to this slide, we saw here that it clearly defined residency, right? Using all these parameters. Okay, so I'm going to try to be very fast now. Of course, not all income are chargeable to tax. For those of us that are worried, this government want to take all our money. Yes, not all income are chargeable to tax. Federal and state government bonds are not chargeable to tax. Dividend, interest, rent, royalty, based on certain conditions we mentioned earlier. Once they have suffered tax, withholding tax, those taxes are deemed to be final. Wages and salaries of military officers. Yes, you can join the army and avoid having to pay income taxes. Some paid as gratuities. I want us to be careful here, because a lot of companies now have a practice where they pay gratuity. They pay a lump sum to employees every 5 or 10 years, lump sum as part of the total package, and call it gratuities. Please, that's not the debt we are talking about. This one has to have been your contribution that is being repaid back to you. Pension, of course, pension is not chargeable to tax. And of course, income of individual earning gross income equivalent to minimum wage. Minimum wage in Nigeria, as we know it today, is 70,000, which means individuals who earn 70,000 and below are not subjected to income tax. Now, of course, a lot of us are familiar with the new band rate. Depending on what you earn, you would have discovered that your salary has either gone up or reduced. That's because of the new band rates that have been introduced. I mean, this table here just showed us the simulation basically using these new band rates. Now, for individuals, what are your eligible deductions? Of course, your NHF is an eligible deduction. Your pension, life insurance premium is also an eligible deduction. Interest on loans for developing owner-occupied property. So for those of you building your houses, if you took a loan to build that house, the interest that you pay on that loan is an allowable deduction. Yeah, okay. All right, let's move on. Taxation of benefit in kind. Now, benefit in kind are just things we call non-cash benefits, basically. Sometimes your company can give you cars as a benefit. They can give you houses, rent as benefits instead of giving you actual money. We call them benefits in kind. This new law is clear as to how those benefits will be packed. Section 14, if your employer provides a house for you, so say the staying here while you are working for us, it's like an employer-owned asset, right? Employer-owned assets, it will be valued as 5% of the cost of the asset or 5% of the market value, and that will be taxed in your hand. If they provide you work tools and work equipment, of course, the tax exemption, BIK expanded. So, PIK, I mean, we've talked about benefit in kind. Time will not really allow me to properly explain what we mean by benefits in kind, right? But just know that benefits in kind, tax exempt BIK expanded to include work tools and work equipment. Annual rents are value is capped at 20% of employees' annual gross. So we can just take note of this benefit in kind, basically. Now, this is the final piece of it, right? Because my time is up. Now, really, implementing these tax laws is just more like the beginning of a new era for us in Nigeria, right? And I know for sure that there will be some teaching phase which we are currently passing through, where there will need to be a lot of clarifications in terms of how these laws are to be applied. But I just believe that as a nation, I think it's time to beyond the noise, try as much as possible to embrace these changes, comply, and we are quite certain that where clarifications are needed for gray areas, then that is where the government will step in and provide some of these clarifications. So I'm just going to stop my presentation here for now, and then we can come back to the house and take comments, contributions, and questions. Thank you very much.
Thank you so much. Thank you so much, Mr. Emmanuel. We are very, very grateful for this wonderful presentation. Like, I've learned a lot today. I have my questions, but I don't want to be the first person to ask. Yeah, I want to really get to hear from others. Please, guys, if we have any questions or comments or whatever we need like an in-depth explanation. Now is the time, so we can take the next 5 to 10 minutes to entertain our questions. I think Emmanuel is here and is willing to. Joke, please, if you can unmute yourself and
Yes.
ask your questions, please.
Good evening, everyone. So,
Good
Emmanuel,
evening.
while explaining the VAT input and VAT output for companies in the oil and gas sector, Their VAT is withheld at source, and also for contract with ministries as well and telecom company. Under the old tax law, we had what they call the self charge of VAT in case you incur an expense and then you were not charged VAT on it. In your books, you are supposed to recognize that. How do we balance this with the oil and gas sector, that the VAT is withheld at source? Is the self-charge tax, is it still applicable?
Thank you. Thank you, Joke. And this sector really always been one sector for which the VAC mechanism is always very impactful. You know, Joke, you said it. In this sector, a lot of the times, you don't even have the opportunity to carry out your input output mechanism, you know,
Yes.
because the VAT that you've charged the other fellow who is also in the same sector, the fellow has withheld it at source.
Mm-hmm.
What
Mm-hmm.
opportunity do you even have to say, let me now claim it against my own output VAT? It becomes a dilemma. And under the old law, really, it was a very serious issue. Oil and gas companies were losing money. When I mean losing money, literally, uh, because people were withholding from them at source, it meant that it was difficult for them to, to attempt to claim back their input VAT. The good thing about this new law is you can actually now seek a direct refund from the NRS, right? Once you do your computation and whether it was withheld at source or not, you can have your schedule for what your output VAT is, have your schedule for what your input VAT is, and the law actually makes it very clear that you can seek a refund directly from the NRS to say, give me my money back because this input VAT has been withheld from me and I do not even have the opportunity to claim it back, right? The law then provides a window of opportunity for the NRS to respond to you. 90 days, they must respond to you, either giving you your refund or letting you know why your refund will not be possible. Um, of course, as practitioners, we are concerned because we know it's it's almost easier said than done. We have not seen NRS give companies back physical money, you know. But now that this law has actually mandated that they give you that refund, then we expect that that refund be actually given to companies who have legitimate claims with respect to input VAT. I mean, I don't know, Japan, I don't know if that clarifies your question. Or you just need
Yes,
to
yes, it does.
with the relevant section of the law. I can't quote it off my head now, but I know there's a section in there that requires the NRF to actually give you your refund within 90, I think it should be 90 days. They either give it to you or tell you why it cannot be refunded.
But is the self-charge VAT still applicable for expenses?
Yes, yes. So where VAT self-charge comes in, Jokia, is you need to first of all take a decision, look at the transaction and ask yourself, is this transaction a vatable supply? If your
Mhm.
answer is yes, then it becomes inconsequential whether there was VAT charged on that invoice or not. The law says you should self-charge and remit. Now, this is particularly important, especially for transactions with non-resident persons. Because some persons will tell you, I do not have obligations to file VAT. I really don't care for your VAT. Just pay me my money. With those type of people, it then becomes important for you to actually self-charge the VAT and then because it makes no difference really whether the person, if the person had charged the VAT initially, you will pay it. But the law is now saying if the person does not charge it, self-charge it and remit it. because it's still technically the same thing.
Okay, thank you.
Thank you, Joker.
Yeah, thank you so much, Jackie, for the wonderful question. I like the fact that this topic actually encompasses every sector of the economy, so we're able to understand it from a different perspective based on the on the on the brackets where we operate, whether it's personal or corporate or whatsoever. So please, any other questions or comments? Anyone coming from anyone, please? Any other question or comment? Well, I don't think anyone wants to ask any other question. So, Emmanuel, I will just go ahead
Sorry,
and ask my own
sorry,
question, please.
one more question, please.
Okay, okay,
This,
go ahead.
how do we get the recording of this session? And then it's when next will there be another session? It's quite insightful, and I quite appreciate the insight into this session has provided.
Thank you so much, Joker. Like I said earlier at the beginning of the class, I said we do have recordings of these classes that we organize, and we used to upload it on our YouTube channel, but it actually depends on the quality of the video we're able to extract. You know, hopefully we'll be able to extract videos that are of quality, and once it's of quality, we usually upload it on our YouTube channel, and then you can follow our YouTube channel. Our our technical admin team is going to share the link to our YouTube channel just in few minutes. If you're a member of our sub platform, we do actually share the link to the YouTube channel once the video is uploaded on our sub platform, so you can follow the lectures, whenever you can on your own time. I hope that works.
Thank you.
All right. Emmanuel,
Please go on.
yeah, please, just a question I know that is on the lips of many, like ordinary Nigerian. You know,
Mhm.
um, everybody keeps saying something on social media. Have you filed your tax return? Have you filed your
Mhm.
tax return? I keep wondering, is filing of tax return for everyone? Let's say, for instance, yeah, you work with state ministry, um, and then we know that this state ministry deduct your taxes before they pay you. Do you still need to file a tax return when you don't run any other businesses attached from the money that you earn from your paycheck? So is filing of tax return for everyone, regardless of how much you earn, regardless of if you work or self-employed? I really need to understand this because I have an old mom. My mom is quite old. She used to work in the ministry. I mean, she still work in the Ministry of Justice. So I want to know because I wouldn't want her to go to jail for not filing her tax return. So it got a lot of people scared. Yeah, there's even my friend that is sending me message that from what you are teaching, it means she might be going to jail very soon. But not. So please, could you actually explain it the way we are going to understand it? Like, you know what I mean? Like, bring it down. Thank you so much.
Yeah, thank you. Thank you for that question, right? So, yeah, like you said, you can actually be working in the ministry, working maybe for a private organization, or even working for yourself, you know. Uh, but of course, where you work, you will find that if those guys are compliant, they ordinarily would have filed your payee for you on a monthly basis. You pay as you earn, which means that they pay your salary, they deduct your tax, they remit, and every year they file, And when they file, they also file that annual returns on your behalf. but that is for you as an employee of that particular organization. Now, you as an individual, you then need to file what we call your own direct assessment, your personal filing as an individual. And you usually have to do this um, March, before the end of March of the next year. And how is this done? Let us assume that you just work for company A and you do not earn any other income from any other source. That's fine. All you need to do is before March of the next year, just go to your personal page on your, depending on where you reside. If it's Lagos State, it will be your LIRS platform. If it's River State, you have to file on their River State Revenue Service platform, right? Just go in there, declare the income you earn from that job, right? And it will then throw up taxes you should have paid, which will then be equal to the tax that that company has remitted for you. So you do not need to pay any extra tax because already remitted taxes on your behalf. So you just go there, declare the income, declare the tax, and file. And it's as simple as that. You've done your direct assessment. But where you earn income from other sources, then it's slightly different. It means that you have to go in there to your direct assessment page, declare the income you earn from the job that you do. You will declare the payee that that job must have remitted on that income. Then you declare your income from other sources. As a big boy, I earn income from this, I earn income from that, I earn income from this, totaling this, right? You then compute the tax that you should pay on those extra income, and then you go pay taxes on those ones, and you file. That is where the slight difference comes in between if I am just working without any other income and if I am working and earning other type of income. Of course, the law did not ask those who are not working to come and pay tax, which is why I find it funny when people say, you see on social media, and a lot of people say the government will take 25% of all your inflows. And I think some 2 months ago, it was very rampant on the internet. You say, oh, government is, the new tax reform has come to take 20%, and you just find that that is a very ignorant statement to make. Because what the law is taxing is your income and not your inflow. Where you have earned no income in the year, there is no tax to be paid. It is as simple as that. So if someone has sent you money and says, Chidimbi, please help me use this money to buy a laptop for me while you are coming back from Kano, and you bought the laptop for that person, the money came into your account, that is not an inflow that will be subjected to tax because it is not an income in your hands. What the law is seeking to tax is actually your taxable income and not just inflows. Yes, as an individual working for a company, the company would have filed your payee for you, right? But before March of the next year, you also need to go in there and make sure you file your direct assessment, which can be just the income you earn from that company, if that is the only income you earn in that year. Or it can be a combination of the income you earn from that company and the income you earn from other sources. In this case, the tax that the company already paid will knock off the taxes from your employment income, while you will then have to pay the taxes on your income from other sources, and then file, and you are fine. So I don't know if that clarifies your question.
Yeah, that is very, very clear. Of course, there's a lot of things I could possibly argue, but not with what you have said, but in terms of the policy, but which will not, which we don't even have enough time to be able to like elaborate more on this, right?
Mm.
Um, but for the sake of time, there is someone, Emmanuel or Rifle that wants to ask his questions. I think that will be our last question for tonight. Emmanuel, please, you have 1 minute, please.
Okay, good evening. Very good job, Mr. Emmanuel, my namesake, and well done to the team for what you've done or what you are doing. My own question has to go with in respect to after you have filed your tax, are you required to pay for your um pay for the tax itself? That's based on maybe like a self-assessment. You have done your self-assessment, you filed it, and then are you required to pay the tax or wait for the LRS themselves to give you an assessment for you to pay? Thank you.
Thank you so much, Mr. Iman. And what a brilliant question. What a brilliant question. Because this has been a topical area in practice. You know, even about it 2 months ago, I still encountered this scenario. And I remember asking a lot of questions myself. What is going on here? Now, I'm going to tell you the position of the law. Then I'll also tell you what is currently applicable in practice. The position of the law is clear. In Nigeria, you file your taxes based on self-assessment and you pay. What that means is the year has ended. As an individual, I'll do my taxes and say, yes, I earn income from XYZ. I'll complete my taxes and XYZ Naira is my tax. I go online, I file, and I pay. Now, if the government is not satisfied with that filing, the law also provides room for inquiries. It's possible for them to, in fact, disagree with what you have filed. And this is where things like desk reviews, audits, even investigations come in. To then say, Mr. XYZ, we're in receipt of your filing, but we've conducted a desk review, and in fact, we think this verified. And then they can write you. And this can open up room for audit, can open up rooms for investigations, can open up rooms for desk reviews, and the whole back and forth. But what we find in practice today, at least I think in Lagos, is you find that an individual has filed on self-assessment as paid, but for some reason you cannot generate your tax clearance certificate because they then tell you, oh, we have to first of all raise it from our own end before you can go ahead to pay. To be honest, I'm not quite sure where that practice has come from, but it's in practice, right? Where someone has to then, upload your filing from their end. And usually this would perhaps be different from what you have computed. And then you start having back and forth. I just believe it's a bit of a deviation from the norm in terms of what the law actually says. The law requires me to file my self-assessment. I am in the best position to know what I earn in the year. And you have to first of all anticipate that I will be well behaved. And if you think I am not well behaved, then of course you can carry out an audit. You can carry out an investigation. But that is slightly different in practice, Emmanuel. What you find in practice is sometimes even if you have filed, discover you can't generate a tax clearance. And when you reach out, they give you comments like we have to raise it from our end and all that. So yeah, we get that in practice. I really can't speak to the why, but yeah, that happens. But it doesn't rule out the fact that in Nigeria, taxation is actually based should be based on self-assessment. I mean, I don't know if that
Oh,
clarified your question.
yeah, I'm
Yes,
sure. Emmanuel,
yes, it's
yeah,
fine.
well,
Yes, yes. Thank you very much. It's clear.
okay. Thank you so much, so much. I think this is our last question for tonight. This is a very interesting and intriguing topic, and I know many of us are willing to stay so long as 3 hours, 4 hours to be able to digest this topic. Hopefully we are going to bring the Emmanuel back again before the end of the year because, I have, for personally, I have loads of questions, especially as regards policy, and the policy implementation, uh, aspect of this, new tax, regime. But be that as it is, we have to move on. So thank you, Emmanuel, for a very insightful section. Personally, I learned a lot and I'm going to pass it on to my mom and I'm sure, I'm sure she'll be happy to avoid going to prison.
I mean,
Thanks to you.
nobody really goes to prison as the first resort. Of course, there
Yeah,
will be procedures, right?
of course.
Tell her to relax, that the law
Yeah.
will not actually throw anybody in prison immediately. But of course, there will be procedure to say, oh, you have not paid, and they will give you room to remediate.
Yeah.
Except that you probably pay some interest and penalties here and there. It is where you fail to remediate that we can now start talking about. Hopefully, nobody has to go.
Yeah, I hope so. I hope so. Thank you so much. It's been so
Right.
wonderful, having you on this section. It's been so wonderful. We hope to have you
Thank you, sir.
again. In fact, you showed a lot of depth. So when you came on the meeting, you said you don't even know that it was you that was trying to introduce. At least you know that to whom a big head is given, much sense is expected. And then you have delivered the volume of sense expected of a big head, yeah, like yours. So, so thank you so much. It's been wonderful
Thank
having
you.
you
Thank
tonight.
you. Thank you, everyone, for
Uh,
having me.
yeah, and thanks to everyone who have joined us, stayed till the end of this section. I saw some of my bosses who joined and they are still here. It shows that what we seek to achieve is beginning to yield a huge, huge result. So for the purpose of those who are just joining us for the first time today, we are S&P Finance Club. So at the heart of what we do is to democratize personal finance in Nigeria and West Africa. So we have members all over the country and all over the world. We have more than 1,000 members everywhere around the world. So, a huge base of our members are Nigerians. That's why it's always interesting for us to talk about the things that affect us, so regards taxations, investment, and etc. So, we have noticed a huge gap in the Nigerian financial sector, and that huge gap of financial education is what we sought to achieve, and it's been wonderful steering this ship since 2020. So we've been here for a very long while. So we thank our stakeholders who has been supportive. Imagine calling out Emmanuel, you know, from his busy schedule. Ladies and gentlemen, Emmanuel works with PwC. I know he wouldn't like that I mentioned this. So he works with PwC. So he's a seasoned tax consultant. So calling him to come and deliver this class without demobilization or paying him a dime is such a huge lift. So the length of sacrifice that many of us have actually, done to ensure that this ministry is still moving is something that we are truly grateful. So we're always open for support in whichever way that you want to support the S&P Finance Club. It may not be just financially, it might be in kind, it might be in the wealth of your experience, it might be in the wealth of your exposure, it might be in sharing contact with industry professionals who can come to speak with us to enlighten us on this our financial journey. It will be hugely appreciated. So always feel free to reach out to me or any member of the admin. My boss is here, but he may not be able to speak tonight, Mr. Joseph Ugu Sep. So you can always reach out to him. You can reach out to our techie, Chika, Miss Chika, the techie, the lady behind everything that we do in terms of tech, in S&P Finance Club, which she has been wonderful, you know. So if you look over the chat, you will see our YouTube channel. You can click and follow our YouTube channel as well. We have the S&P Finance blog, you know, so you can also click and view some of the, the articles shared by our team members or our leaders in the sector. And we have the WhatsApp platform. So if you're not a member, or you can hit me up if you want to join. Chika, please, can you share the link to all of this platform? It would be nice for people who would like to follow through to actually click on those links. Okay. So this is who we are. So we thank you guys for tonight. We thank you for staying through to the end. I hope to see you all next month. Next month we have a very interesting topic coming on. I can see Mukta Mukta is one of our boss in the stock exchange anyway. So he has also been wonderful, and a lot of us have been wonderful. I want to thank especially the PwC team, Kelechi. Kelechi is hiding in the shadow. And probably she's smiling right now for calling her out. Yeah, thank you so much, guys, for your support. It's been wonderful. We are always open for any form of support coming from you guys. We are here because you guys are here, and we can't be ourselves without you guys. So thank you so much. Thank you, everyone. I hope to see you guys next month. Yeah, bye.
Bye. Thank you.
Thank
Bye.
you.
Good night. Thank you so much.